Hey guys, how's it going? It's Andy from MagooInvesting. Happy Wednesday. This has been a video that I've been putting off for a long time. It went onto my radar about a month ago, and I've kind of just been putting off actually talking about it because it's a long-winded topic. But after the steep decline that we saw at the end of Tuesday for the stock market, where things closed 2% down, which was actually the first time in the month of May that the stock market was actually red. When I put up the chart, you can see that it was just steadily going up, and then Tuesday was the first time we saw it start going down. I don't think it's going to result in a stock market crash like what we saw with the virus, but this is something where I think it's going to be a problem going forward, and I wanted to talk about it in depth on this channel. In this video, I'm going to be talking about stock buybacks and why I think it's going to be a huge problem going forward compared to what we've seen in the past. With the stock market going into 2020, everything's been going very well, but I think stock buybacks are going to be a major player for why I think things aren't going to go that great towards the end of the year. So in this video, I'm going to start off by talking about Boeing and identify some of the problems that I've seen with their behavior over the past couple years. Then I'm going to go talk about Microsoft and Apple, some of the things that they've done well, and then I'm going to introduce the idea of stock buybacks, explain them in depth, and kind of explain some of the main problems that I see with this practice. Before getting started, I have to say that I'm not a financial advisor, and this is not financial advice. This is just me talking to my room about some opinions that I have about the stock market. So if you've been enjoying these videos recently, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. At this point, we're getting really close to 3,000 subscribers, so thank you for that. So first off, let's start by talking about Boeing, ticker symbol BA. This is a company that I recently talked about on Friday, where I talked about my undervalued stocks to buy for May of 2020. And this was one of the main players in that video. At this point, the stock is trading for around $125, but when you look at the 5-year chart, you can see how quickly the stock has fallen from its highs of $440. From the research that I did for Friday's video is kind of the main reason why I'm talking about this now. Boeing ended up screwing itself over with stock buybacks. Like pretty much everyone that's a part of the airline industry, they've been hit very hard. The travel bans and the restrictions on travel overall have made it so the demand for air travel is pretty much zero at this point. And so they've been crushed during this time. At this point, all of the major airlines have taken loans from the federal government, but Boeing came out and said that they did not want assistance at this point. The main reason behind that is that they didn't want the taxpayers to own part of the company, which was part of the deal agreed to with the federal government. So why did these airlines have to get bailed out so quickly? When we look at the past decade, airlines have made around $49 billion in free cash flow in the past decade, and they've spent $47 billion of it on stock buybacks. So I hope that you're starting to see the problem here. Free cash flow is a way to kind of determine how much money a company is bringing in after taking account all of the expenses. So it's revenue minus expenses gives you free cash flow. And so over the course of the past decade, around 95% of the airline's free cash flow has gone towards stock buybacks. And this is a great opportunity for me to criticize my least favorite stock at this point, which is American Airlines, ticker symbol AAL. During this time, they were the only airline to have negative cash flow by losing $8 billion in the past decade. And then they made up for it by spending $13 billion that they didn't have on stock buybacks using debt financing. Looking at Boeing, they're slightly better with $58 billion in free cash flow, with $43 going to stock buybacks. That also doesn't include the dividend. So in an effort to stay afloat, Boeing has cut its stock buybacks and their dividend as a way to kind of save themselves during this time. Even though they've made almost $60 billion in the past decade, they don't have enough money to stay alive at this point. So in this video, I'm going to be explaining some of the dangerous practices that we've been seeing with these companies. And first, I want to talk about some of the ways that companies have been using stock buybacks correctly. So looking at Microsoft and Apple, these are kind of the pinnacle of stocks. When you invest in a company, you hope that it ends up being as well run as these two companies. In the first half of 2019 alone, Apple spent $42 billion in stock buybacks, and Microsoft came in with $9 billion. So why am I being very nice on these two companies when I just talked about some of the problems that Boeing had? And the main difference is that Microsoft and Apple, they're sitting on so much cash that the $42 billion and the $9 billion aren't hampering their ability to stay afloat in the future. At one point, Apple had $200 billion in cash on hand. And at that point, people were getting kind of upset that they were sitting on so much cash. And kind of the similar thing you've seen with Microsoft. And what do we know about these two companies compared to Boeing? They are perfectly fine during times like this. And these were one of the main reasons why these two companies were on my top stocks to buy for May of 2020. They have so much cash on hand that I'm not worried about them needing to dip into more loans or trying to protect themselves in the future. There's also a huge reason why when I talked about Starbucks, while they've been hit pretty hard this year, they have a lot of cash on hand. So I'm not worried about them going under or going bankrupt during this time. So as a summary, Apple buys a lot of shares back. Microsoft buys a little bit back, but they have a pretty decent dividend. But they have enough to stay afloat during crazy times, like a pandemic. And all of the airlines and Boeing have shown that they have spent so much on stock buybacks that they cannot survive these times. So now that I've introduced some of the problems that we've seen with stock buybacks, how they can be used effectively, let's explain what stock buybacks actually are. So the main idea of a stock buyback is the company goes and buys shares of their own company off the open market. So they're buying it at market value, and it reduces the number of shares available. And so if nothing else changes with the company, you're reducing the shares available, which boosts the overall value of your individual shares. And so when a company announces stock buybacks, which they legally have to do, it usually goes up for two main reasons. One is the thing I just mentioned, is that there's less shares, so each share is now more valuable. But the other reason is that investors usually look at it as a sign of confidence with the company. It's usually worded in ways like, we think that the best way to invest into the future is to invest in ourselves. So it's usually seen as those two positive ideas for why the stock ends up jumping after they announce share buybacks. However, this is where we start to get into the tricky areas of stock buybacks. But in my opinion, it kind of manipulates some of the trends and ratios we look at as potential investors. One of the main ones that it affects is earnings per share. And so if a company earns the same amount of money year over year, but they continue stock buybacks, there are less shares over there. So the earnings can stay completely the same. But since there's less shares, it's going to increase in value. And so it's a way to artificially inflate a lot of things besides the overall share price. And so in addition, it can manipulate things like return on investment and PE ratio, because as I mentioned, the earnings per share are going to increase, which is going to lower the ratio for PE. So while in the short term it boosts the overall share price, it somewhat manipulates a lot of the things that we look at as potential investors. And so with a lot of the tech companies, we're starting to see a trend of companies going towards paying dividends to their shareholders to going to mainly stock buybacks. One of the main reasons behind that is the differences in taxes. If a company pays out a dividend, it gets accumulated as income tax because it's directly paid to the shareholder. And that differs when you look at stock buybacks because it just increases the overall price of the shares you own. So if you're holding it for a long-term investment, it's going to be taxed at capital gains tax rates, which are significantly lower than your normal income bracket. And so that's why recently we've seen companies like AMC, which is the theater company, they've stopped their dividend payout and they started investing heavily in themselves with stock buybacks. And since the company has fallen so far in the past, I'll put up the 5-year chart right now, it makes it so it looks like a good value for them to invest in. And so this is one of the rare times when a company cut their dividend, but the stock price goes up because they announced that they're going to heavily invest in themselves with stock buybacks. In addition, for when a company decides that they need to kind of slow down their stock buybacks, it's not considered as bad of a move compared to if a stock cuts a dividend. When a company cuts a dividend, it's usually seen as the company is struggling and they're just kind of trying to stay afloat. That's why in the past when I was investing in Macys, I was waiting to see if they were going to cut their dividend because that would be kind of the last blow, the last red flag that would have to go up for me to sell my shares. But if a company cuts their stock buybacks, it's not considered as negative as it would be if they're cutting their dividend. So when you look at companies, they have three options that they can do things with their free cash flow. The first one is they can just sit on the money. They can just hoard it for as long as they want. You've seen that with companies like Berkshire Hathaway and Apple. But when you get to the point where you have so much cash on hand, a lot of investors are going to become restless because they know what can happen when you start investing in yourself. So you have that option. You can pay out to the shareholder in stock buybacks or dividends, or you can invest in yourself in a different way by looking at research and development or R&D. And now this is where I start to see some significant problems. When we look at the S&P 500, only 43% of the companies in that index spent any money on R&D in 2019. 43%. This becomes a problem when you start looking towards the future. Companies are starting to invest in themselves in the short term compared to R&D, which gives long-term security for the company. And out of those 500 companies in the S&P 500, 38 of them accounted for 75% of the R&D spending overall. So we see this disconnect of where this free cash flow is going. You see companies like Apple, Berkshire Hathaway that are sitting on a lot of cash to protect themselves. They get criticized for not using that money wisely. But then you have none of these companies are investing in themselves for R&D, and it's only going towards stock buybacks. In the past decade, 52% of all net income was used for stock buybacks, and around 40% of it was used for dividends. So at this point, none of the money is going towards long-term growth of the company. So at this point, I'm kind of arguing against an idea that helps me as an investor. When stocks buy back their shares, it increases the value of the shares I own, and it makes everyone make money. However, now that we're seeing some of the risks associated with it, we have the pandemic coming in right now, which is likely going to be followed by a recession, and a lot of these companies have been cutting their dividend and their stock buybacks. And stock buybacks are a significant part of the overall demand of the stock market. So that's what I'm going to be watching going forward. Because of the huge increase that we've seen in stock buybacks in the past decade, they've become the most common way that companies are using their free cash flow. When you look at 2019, more than 100% of all of the company's free cash flow went to dividends and stock buybacks. More than 100%. I can't even fathom how much they're spending on this. It's ridiculous to me. So now we get to the problem, and how are we going to fix this? At this point, I don't think it can be fixed from the way companies are being run right now. We've seen a lot of the companies that have had problems with this, mainly the airlines and Boeing. They needed assistance very quickly, and they got that. It seems like the federal government is not going to allow these companies to fail. And so we're seeing a trend where executives that make these decisions for when they want to authorize stock buybacks, it helps them for many different ways. It ends up raising the stock price, it limits the damage of short sellers, and it usually gives executives huge bonuses because the stock price increases significantly. So at this point, a lot of the changes are not going to be coming internally. I'd like to see some changes from maybe the SEC, maybe limit how much companies can spend on stock buybacks. Currently, I think it's 25% of the total volume in any quarter, but I think it should be significantly lowered in the future. While it will limit the upside potential of the stock market, I think it comes with overall stability. I've talked about the enormous disconnect we've seen between the stock market and how the world is working right now, and I think stock buybacks are a huge part of that problem. And while I've seen a little bit of public outcry in the past couple of months, especially with the airline stocks, I don't think that I've seen anything else besides that recently. The stock market has been going up, and when things are going well, people are going to be very content with their gains, and they don't see the problems that it's creating in the future. And so that's why I'm kind of worried going forward. At this point, the pandemic has not really affected the stock market in the way that a lot of people expected. And so until we see the stock market fall, I think stock buybacks are going to continue to be a huge problem. In the future, I think stock buybacks are going to be a huge problem. At this point, they've been cut or suspended for most companies, and so it's going to limit the amount of volume that's going to be traded on the stock market, which will make things more vulnerable if we have short sellers coming in and the selling comes in more than the buying. Those are some of the risks I'm seeing with this. At this point, it's not going to be changed internally because of all of the incentives that these executives have for stock buybacks. But I think it's a huge problem, and I wanted to bring it up in a video. I'd love to know what you guys have to say about stock buybacks. It's great for the investor, but I think it's a problem for the long-term security of the stock market. So I'd love to hear what you guys have to say about that. Thanks for watching, stay inside, and I'll see you in the next video.